Okay. Remember, tax will always follow the legal principle. The only time tax will not follow the legal form of a transaction is if one, there's a specific anti avoidance provision, which tells you in these criteria we will do X, such as, for example, Section 7C, or if we can prove that the substance is actually a sham. In other words, that the legal nature of the transaction doesn't actually reflect what was intended to be the true form of the transaction. So, from that point of view, is with a loan account, the only time SARS can actually ignore something as being a loan account is if they can show that it actually doesn't meet the common law criteria of a loan agreement and was intended to be something else. Which is why SARS cannot compel you to ever charge interest. They can simply levy tax consequences via an anti avoidance provision if your loan is interest free. So, but in order for something to be a loan agreement, there must be an actual obligation to repay an amount that's contractually agreed between two parties. That's the common law definition of a loan account. And what has happened is that SARS has successfully been able to prove that in certain circumstances, if you looked at the true nature of the transaction, and this was particularly prevalent with individuals and trusts, that there was never actually an intention for the amount given to the trust to be repaid. Therefore, it wasn't a true loan. It was actually a sham transaction, and they looked through it and treated it as something else. Right. But those circumstances are exceptional. They have to be able to demonstrate that there's no true intention to repay the amount. Generally, if a shareholder has lent money to a company, so in other words, it's a credit loan in the company, right? Um, then you should be able to show that there is a genuine intention to repay the amount. How? By having your balance sheet reflect um, a liability to the shareholder, for example. It shows an intent that, yes, I agree and concede that that I owe this amount. Okay. So as long as you can show there was a genuine obligation to repay, you're fine. In trusts, they might look at it a bit more carefully because that's where some of the anti avoidance really tends to kick in. Right. So, what are some of the anti avoidance provisions which could kick in here? Now, there are some where you have interest free loans from a shareholder to a company, but they're generally very limited. It's mostly where there's excessive interest where you are going to end up having tax consequences. All right. About the only anti avoidance provision I can think of where a loan account between a shareholder and a company could possibly have an anti avoidance provision is Section 7C. Is if the company actually happens to have a trust as a shareholder as well, then there might be 7C, right? If, however, the company has lent money to a shareholder, now we're in a position where quite a few anti avoidance provisions could kick in. For example, Section 64E4, which deals with the deemed dividend on loan accounts to connected persons. Right. We have the potential that that loan should actually have been a salary and not a true loan account, which again comes back to can you prove this isn't just a sham transaction? Right. The credit loan in the company is actually probably one of the cleanest from a tax point of view you will get. Right. I've done the numbers and I've gone and and I think at last point we are looking at about 9 provisions, which deal with where interest is charged and or not charged, and anti-avoidance provisions. But most of those generally do, other than 7C and 64E4, they generally deal with situations where interest is charged. Okay, I suppose the other third one is if your shareholders are non-resident, then you could have transfer pricing. But otherwise, this is going to be a very simple, and SARS is just going to accept it. Right. The other thing to remember is that if a loan is interest free and you, as the lender, so in other words, in this case, the shareholder, has lent money interest free to a company, but you've borrowed the money from somewhere else, then you would be paying interest expense, and that interest expense would not be deductible because you aren't applying that interest expense in the production of income, because you cannot link it directly to an income amount. So you need to please consider that. Okay.